Welcome to the Deep Dive. We're here to cut through the noise and really get you informed on topics that, well, that truly matters. Today, we're plunging into a corner of the financial world that's generating a lot of buzz. A huge amount, actually. But maybe not in the way you might think. Forget the speculative roller coaster of Bitcoin or the latest meme coin making headlines. Our focus today is much more specific, but it has potentially monumental implications for the global financial system. We're talking about a wholesale central bank digital currency, a WCBDC. And even more precisely, we're looking at how a wholesale digital euro could fundamentally revolutionize Europe's debt capital markets, which are, let's face it, incredibly complex, high-stakes stuff. Think of this as your essential shortcut, your way to understand a crucial but often overlooked innovation that seems poised to reshape global finance. Now, our insights for this deep dive, they come directly from a really compelling and remarkably thorough discussion paper. It's published by the European Stability Mechanism, the ESM. If you're looking at the visuals that go with this deep dive, you'll see that European map, the ESM logo. It signals our clear focus, European financial stability. This isn't just theory floating around. This paper rigorously analyzes the real-world usefulness of digital currencies. And it focuses intently on how they could be applied for wholesale financial transactions, specifically within Europe. Honestly, it's a treasure trove of detail, granular detail and strategic foresight. It feels like a blueprint for the future, in a way. So our mission today, pretty clear really. We're here to unpack exactly how a wholesale digital euro, one underpinned by distributed ledger technology, DLT, and smart contracts, how this could make the financial system faster, more efficient, and importantly, significantly safer. We'll explore how it tackles existing risks, the ones that have plagued traditional finance for decades, and maybe even more importantly, how it overcomes those persistent hurdles that have, well, until now, prevented these powerful technologies from being broadly adopted in mainstream finance. Now, you might be thinking, debt capital markets, that sounds incredibly niche. How does this affect me? And that's a perfectly valid question. Absolutely. But here's the crucial connection. The efficiency and stability of these massive markets, they directly influence, well, pretty much everything, from government borrowing costs, which impacts public services, taxes, to investment opportunities available to institutions. And that then ripples out into broader economic growth and stability. So understanding these foundational shifts, it's absolutely crucial because they ultimately impact the economic landscape that touches your daily life. Think interest rates, economic growth. Stick with us, because I promise there are some genuine aha moments coming. And to help us navigate this intricate landscape, I'm thrilled to be joined by our resident expert. Always manages to connect the dots, provide that essential context.
It's genuinely great to be here for this. Yeah, this topic feels like it's been bubbling under the surface for quite a while now, and it seems like it's finally reaching a point where its potential is, well, becoming undeniable.
So let's unpack this from the beginning then. Where did all this talk of digital money, blockchain, where did it really start? It certainly didn't just materialize out of thin air, did it? Feels ubiquitous now, but there must be a genesis moment.
You're absolutely right. No, it didn't just appear overnight. The very first seeds of this digital disruption in finance, we were sown back in 2008 with the publication of a white paper, Bitcoin, a peer-to-peer electronic cash system, by the enigmatic Satoshi Nakamoto. This paper proposed a truly radical idea for the time, a financial system that could operate entirely without traditional banks as central intermediaries. It introduced the concept of a transparent, immutable, public blockchain, where all transactions are recorded, verified by a decentralized network, using a process called mining to achieve consensus. This was a genuine paradigm shift, really. It allowed for instant peer-to-peer transactions without a central authority verifying balances or, managing the money supply. Instead, sophisticated algorithms took over that critical function. It essentially offered a way to build trust in a trustless environment. Then, building on Bitcoin's foundation, Ethereum emerged. That was the next crucial evolution, taking things several steps further. What Ethereum added was something truly groundbreaking, smart contract functionality.
This is a critical leap because, well, Bitcoin focused primarily on simple cash transactions. Ethereum dramatically expanded the possibilities. It allowed for the representation of virtually any asset, physical, digital, whatever, as a cryptographic token on the blockchain. But more than that, it enabled the creation of decentralized applications, or dApps. These could run autonomously on a peer-to-peer network. Imagine like a legal contract that doesn't just record an agreement, but automatically executes its terms when certain conditions are met, all without human intervention. This stretched blockchain's utility way beyond simple money transfers. It enabled really complex automated agreements, self-enforcing ones. And to truly complete this toolkit for end-to-end automation, we saw the clever introduction of oracles, Think of oracles as the indispensable bridge. They connect these self-contained blockchains to the vast external world. They are reliable entities that feed real-world data like exchange rates, stock prices, even specific environmental data, say solar panel output, directly into smart contracts. This multiplies the automation capabilities exponentially.
For instance, the paper gives a perfect example. Two parties in a smart contract could agree on a future payment. It automatically executes based on how an exchange rate develops. An oracle provides that crucial, real-time external data feed. It makes smart contracts truly smart by giving them external awareness, So all these foundational elements, DLT, smart contracts, oracles, they pave the way for the emergence of decentralized finance. DeFi. This is an environment that's, characterized by being deregulated, permissionless, open source, which drastically reduced entry barriers for developers, for investors, everyone really. DeFi promised and in many cases actually delivered significantly lower service costs and faster transaction times. How? By cutting out many traditional middlemen who charge fees and add complexity. It was about creating a more direct, more efficient financial ecosystem. Alongside this rapid evolution, new on-ledger instruments started to emerge, designed to provide some stability in a pretty volatile environment. Probably the most well-known are stablecoins. They're specifically designed to maintain a stable value, usually by being pegged to a reference asset, like the US dollar. The source mentions fiat collateralized stablecoins, issued by corporates who claim to hold commercial bank money reserves, backing each stablecoin one-to-one. These are seen as potential on-ledger cash instruments for settling tokenized asset transactions. Then there's tokenized commercial bank money, issued by commercial banks themselves, backed by their assets. And a more advanced concept, synthetic CBDC, is another private actor option, where a financial institution issues an on-chain token backed by reserves it holds at a central bank. These developments were all aimed at providing more stable, more reliable on-chain cash instruments. To facilitate high-value transactions in this burgeoning digital ecosystem.
This all sounds incredibly revolutionary, genuinely, like the future of finance unfolding. But here's the burning question, isn't it? If these technologies offer so much, if there's such a clear path to efficiency, why haven't they already been broadly adopted in mainstream finance? What's really holding them back? It feels like such a natural progression, but clearly there are significant obstacles.
That is the critical question. And the ESM paper, thankfully, doesn't shy away from it. It tackles it head-on. It highlights three main factors that have limited the broad use of DLT for financial transactions in mainstream finance. First, there's the pervasive issue of legal uncertainty and risk management. While DLT definitely has the potential to reduce some existing risks in financial operations, it simultaneously introduces new vulnerabilities, new legal ambiguities. And these are currently managed with highly mature, well-established systems in traditional infrastructure. For example, ensuring Know Your Customer, KYC, compliance. Navigating the existing complex legal frameworks around the very nature of digital assets. Are they securities? Commodities, what are they? These are still areas of significant uncertainty. The legal status of digital tokens is often unclear. A large percentage of central bank laws still limit currency issuance authority to physical banknotes and coins. This creates a legal gray area that's a substantial barrier to broad adoption by, risk-averse, regulated financial institutions.
Right. It's like building a super fast car, but not having clear traffic laws for it yet.
Exactly. That's a good analogy. The second major hurdle, and this is truly critical for wholesale markets, is the lack of on-chain central bank money. Any complex financial transaction typically has two legs, right? An asset leg, say a bond, and a payment leg, the money exchanged for it. If assets are tokenized on a DLT, ideally the payment leg should also happen directly on-chain to get the full benefits, programmability, instant settlement, automation. However, without central bank money directly available on-chain, meaning money that carries zero credit and liquidity risk, the highest standard you're left with private payment tokens, stablecoins, tokenized commercial bank money. The issue here is that these introduce their own inefficiencies and risks. You face the necessity of pre-funding, which can add friction, and credit risk on the issuer of these private tokens. The paper explicitly states that private creation of payment tokens would not allow to benefit from all the costs and time savings, nor ensure all the risk reductions identified for wholesale CBDC. Essentially, to get the full benefits, to truly leverage the technology for high-value transactions, you need the highest standard of money, central bank money directly on the ledger.
It's the missing piece of the puzzle for truly seamless, risk-free settlement.
Precisely. It's absolutely crucial. And third, the threat of fraud and value volatility. This has dealt significant reputational blows to the broader cryptocurrency market, which fairly or unfairly often gets conflated with DLT itself. We've seen major incidents. The widely publicized fraud and collapse of FTX, for example, which was related to fraudulent management, a severe lack of regulation. There's also the Terra USD collapse, an algorithmic stablecoin that malfunctioned spectacularly, causing huge losses, though this was due to stablecoin design flaws, not DeFi functionality itself. These high-profile events, combined with broader macro developments like rising interest rates, inflation, they contributed to the market value of all cryptocurrencies tumbling by over USD 2 trillion since early 2021. This inherent volatility in the instances of fraud naturally deter mainstream financial institutions. They quite rightly prioritize stability, security, regulatory compliance above all else.
They just can't afford the risk, reputational or financial, not in that kind of unregulated, volatile ecosystem.
Exactly. So despite these very significant shortcomings, these undeniable challenges, the paper's core argument is clear and compelling. It says the technology offers huge efficiency gains across financial transactions, provided these shortcomings can be overcome. This powerfully sets the stage. It helps us understand how a wholesale CBDC, meticulously designed, implemented correctly within a robust regulatory framework, how that can address these exact challenges and unlock the true transformative potential of DLT in high-value financial markets.
So it's about building a robust, regulated, reliable digital infrastructure, not just a wild west of crypto.
Precisely. That's the key distinction. What's truly fascinating here is how a wholesale digital euro isn't just about digitizing money. It's about unlocking massive efficiency gains. It's about reducing systemic risks, strengthening financial stability across the entire system. Let's delve into these multifaceted benefits. Firstly, think about the immense potential for increased speed of execution and massive efficiency gains through programmability. Today's complex financial transactions, they involve numerous actors, multiple tiers of intermediaries, a high potential for human error as steps are manually verified, reconciled. It's messy. Smart contracts fundamentally transform this. They automate contractually required steps for payments, for settlements. Think about a sovereign bond issuance, for example. A key step for bidders would be locking their funds into a smart contract. This contract would then automatically execute when the deal closes, either transferring the funds to the issuer if the bid's successful or immediately releasing them back if it's too low. This cryptographically resolves the counterparty risk bidders failing to stand by their bid, and it does so at very little cost, often instantly.
Both issuers and bidders can trust in a smooth, frictionless operation, governed by a transparent smart contract executed by a trusted system. While it's initially applicable to auctions, the paper suggests this programmability could extend even to syndicated issuance. If allocation rules are clearly defined and coded, the ultimate outcome is clear. A programmable on-chain WCBDC would foster end-to-end automation of debt issuance, thus accelerating the speed of execution.
Taking processes that take days down to seconds, potentially.
Exactly. That's the scale of change we're talking about. Secondly, we gain the immense benefit of enhanced trust through transparency and immutability. Blockchain's key novelty, really, is the inherent transparency of records. At any point along the process, this is powerfully reinforced by the immutability of these records, meaning they can't be retroactively altered or deleted, ensuring their integrity over time. This on-chain code replaces traditional, often opaque, written contracts, providing remarkable auditability. All actions required by the code in smart contracts are readable, checkable at any point in time by all authorized participants. This offers an unparalleled level of verifiable truth. It builds fundamental trust right into the system. However, this very immutability introduces a challenge, often called the fat finger risk.
Ah, yes, the accidental big error you can't undo.
Precisely. The potential for a user input error, which, once submitted, can't be easily undone. The paper astutely addresses this. It proposes practical mitigation strategies. Technical parameters could be designed to allow investors to update or cancel bids up to a certain predefined point. A sandbox environment could be used for rigorous testing of smart contracts before live deployment, like a flight simulator for pilots, And for private blockchains, an exception management system could be implemented to override immutability in very special, pre-approved cases, ensuring flexibility without compromising integrity.
So the benefits of transparency and immutability aren't necessarily at the cost of irreversible mistakes. There are ways around it.
Correct. There are well-thought-out safeguards. Now, a truly unique and specific new use case of WCBDC, and one with significant implications for sustainable finance, lies in purpose-bound money, PBM. This is particularly relevant for ESG-related bonds, green bonds, social bonds. PBM allows for the programming of the intended use of proceeds directly within the money raised from investors. This means the use of funds, as committed by the issuer, can be traced on-chain. From issuance right until the final disbursement for the intended committed purpose, this directly mitigates risks of greenwashing, where funds from green bonds might not actually be used for green projects. We hear about that a lot.
Yeah, that's a huge concern in the ESG space.
It is. So this significantly improves reporting and thus powerfully supports trust and transparency in the labeled ESG bond market. It could even enhance the greenium. That's the reduced funding cost for ESG bonds due to increased investor confidence in their authenticity, their impact. We're already seeing real-world examples reinforcing this concept. The Monetary Authority of Singapore. They've published insightful reports on PBM. While their initial focus was retail, the underlying logic applies directly to wholesale. The Japan Exchange Group, for instance, intends to issue a digitally tracked green bond, leveraging solar panel output data directly linked to the bond token for transparent reporting. Pretty cool.
That's very specific tracking.
It is. And this isn't limited to ESG either. The technology is use case agnostic. Imagine government spending programs, like the disbursement of EU funds under specific regional or sectoral conditions. The use of funds could be precisely tracked on-chain, ensuring accountability. It's important to clarify, though, PBM is a design feature allowing private users of CBDC to program purpose-bound conditionality.
So the central bank isn't dictating how euros are spent.
No, exactly. It's providing a programmable infrastructure for users to enforce their own commitments. That's a key distinction. Another critical aspect we navigate is the delicate balance of privacy considerations. While transparency is a huge benefit for auditability, privacy is absolutely essential in competitive markets.
Of course, bidders in an auction don't want competitors seeing their bids in real time. Institutions keep holdings private.
Right, so the paper outlines several robust ways to manage this trade-off. Public blockchains like Ethereum offer pseudonymity. Only public addresses are visible. Though there's a theoretical risk of tracing transactions if addresses become known. That risk can be mitigated by creating a new wallet for each action, but it's still there. More robust privacy can be achieved through advanced IT solutions, like trusted execution environments, Oasis Protocol as an example, or cutting-edge cryptographic solutions, such as zero-knowledge proofs. These allow one party to prove they know something without revealing what that knowledge is.
Like proving you're over 18 without showing your birth date.
Exactly like that. These proofs have been successfully demonstrated for anonymous seal bid auctions already. However, the most practical and probably secure approach for wholesale CBDC, as the paper suggests, is a private permission DLT. This type of network allows for arbitrary degrees of privacy. Node operators, typically regulated financial entities and regulators, would have full visibility for oversight, while regular participants would only see their own transactions or those explicitly shared with them. This controlled environment is crucial. It maintains both regulatory compliance and the commercial confidentiality essential for competitive markets. Now, a primary paramount concern for central banks, especially the ECB, is fortifying financial stability. Restricting WCBDC access initially to current Target 2 users, that's the Eurosystem's large value payment system, offers immediate operational efficiency gains, adds robustness to the existing system. But the true enhancement of financial stability comes if access is broadened. This would allow more participants into a low-risk instant settlement environment, avoiding credit and liquidity risks inherent in private payment tokens. It essentially brings the safety of central bank money to a wider array of financial transactions, addressing the very valid concern that broader access might increase bank-run risks. The paper proposes smart, elegant solutions. A variable wholesale CBDC interest rate below the commercial bank deposit rate could disincentivize holding digital euro just as a store of value, keeping commercial bank deposits attractive. Alternatively, a refinancing approach could substitute commercial bank deposits with central bank lending. Crucially, smart contracts themselves could be equipped with switches or brakes to prevent too many commercial bank deposits of a single bank being converted into WCBDC too quickly, acting as an automated circuit breaker.
Like built-in safety mechanisms?
Exactly. Furthermore, regulators having real-time access to platform operations allows for timely intervention during financial shocks, significantly enhancing systemic resilience. This overall approach aims to make the euro financial system not just faster, but fundamentally more resilient. When it comes to achieving scalability and cross-border interoperability, smart contracts with their generalist scripting language are key. They ensure forward compatibility and scalability of DLT-based platforms. We don't know exactly how many digital currencies will emerge globally, right? But interoperability can be ensured at low cost. For instance, hashed time lock contracts, HTLCs, can facilitate atomic swaps between arbitrary blockchains, even those built on different programming languages, decoupled ecosystems.
Think of it like a universal adapter for different digital currencies. A prime example of this cross-border payment efficiency, the BIS Innovation Hub's Project Enbridge. This multi-CBDC platform aims to reduce cross-border payment costs by allowing multiple central banks to issue and exchange their CBDCs on a common technical infrastructure. Imagine a world where euros and dollars are both tokenized on programmable blockchains. HTSCs would allow two actors to exchange these tokens using different platforms, without needing layers of intermediaries or costly FX conversions.
That sounds like a potential game changer for international finance, making cross-border payments cheaper, faster, more transparent.
It really could be. Now let's talk about comprehensive risk reduction and mitigation. A WCBDC offers significant potential to eliminate or substantially shrink existing risks, the ones that plague traditional financial markets. Settlement and central bank money, inherently risk-free, unlike alternatives that carry credit or performance risks. On-chain records are immutable, protecting against unauthorized changes. Automation eradicates human error in daily operations, reducing costly mistakes. An instant settlement dramatically shrinks open positions between legal commitment and execution, reducing market risk, hedging needs.
It's like turning a multi-day waiting period into an instantaneous exchange, collapsing risk exposure.
Precisely. It's a huge reduction in temporal risk. However, it's vital to acknowledge new risks do emerge with DLT, but the paper emphatically argues they can be efficiently mitigated. A key area of focus is anti-money laundering, AML, and combating the financing of terrorism, CFT. In the primary market, issuer checks function similarly to today. Banks act as intermediaries. The challenge arises with secondary market peer-to-peer transactions without intermediaries, where illicit funds could potentially move. Solutions include using an intermediary custodian with the private key to the investor's wallet, who's regulated to perform KYC mail checks. Technical standards often referred to by their Ethereum request for comment numbers like ERC 1400, ERC 1404, ERC 482, particularly ERC 1404, can be used for whitelisting. Setting selling restrictions, limiting token transferability to approved entities. Most effectively, a private permissioned blockchain allows regulated entities to operate nodes and perform KYC checks once for the whole network, leading to additional efficiency by streamlining compliance. Experiments by the BIS Innovation Hub, Banque de France, MAS Tau, they've already successfully demonstrated these mechanisms.
So what does this all mean for the idea of disintermediation that we hear about so often with blockchain? If intermediaries are still performing crucial roles like AML-CFT, is that threat still as relevant, or is it more about a transformation of their role?
That's an absolutely crucial point, and Box 1 in the source addresses this directly, firmly. Traditional stakeholders in wholesale financial markets like the ESM do not support disintermediation, meaning they don't advocate for cutting out all the middlemen. The paper emphasizes that neutral intermediaries like banks continue to play the key role in the protection of the general public against criminals laundering money and terrorism financing. Any robust financial infrastructure, legacy, or on-chain must ensure proper enforcement of AML and CFT rules, primary and secondary markets. So while the technology could technically allow disintermediation in some areas, the societal imperative to prevent illicit finance means that regulated intermediaries remain essential, albeit with potentially adjusted or streamlined roles.
So the threat of complete disintermediation, particularly for these critical public protection functions, isn't the desired or likely outcome in a regulated WCBDC environment?
No. It's more about making existing crucial roles more efficient, more integrated, moving to cybersecurity risks. The stakes are incredibly high in wholesale capital markets. Billions of euros, US dollars at play. There's an extremely high incentive for potential hackers, obviously. Some specific security risks, like 51% attacks where a single entity gains control of most of a decentralized network to manipulate transactions, are specific to proof-of-work blockchains. But these do not exist for private permission blockchains with a trusted notary, which is the proposed architecture here.
So that specific risk is mitigated by the design choice.
Correct. However, common risks like phishing or routing attacks still need robust safeguards. Standard cybersecurity hygiene, but elevated. A more specific DLT risk is faulty smart contracts, where a poorly written contract could contain vulnerabilities leading to huge financial losses. Mitigation involves classic, rigorous information security measures, extensive code audit and penetration tests, methods to detect metamorphic smart contracts that can change their code after deployment, adding hidden risk. Finally, let's turn to the realization of significant cost savings. These savings flow directly from all the efficiency gains, the risk reductions we've discussed, and they impact the entire value chain of debt issuance, from initial preparation right through to ongoing debt service. Specific savings include reduced staff costs and reparation costs from human error.
Think about that fat finger risk being managed by sandbox testing, exception management. Instant settlement can eliminate liquidity and hedging costs by collapsing settlement times. Risk reduction directly leads to lower operational costs and reduces the costs that would be incurred if those risks materialized. Increasing central bank money settlements reduces risks and associated costs of settlements in commercial bank money. And as we noted with purpose-bound money, the reinforced greenium for ESG bonds through increased transparency and auditable use of funds records that can significantly reduce reporting costs and ultimately funding costs for issuers. The paper does briefly mention a potential for increased costs if you went for a technically feasible 24/7/365 service for a decentralized infrastructure with WCBDC. But such service would only be provided if its benefits clearly outweigh those operating costs. It's also acknowledged that the magnitude of cost savings remains uncertain at this experimental stage, as with any new tech.
Sure, that makes sense. But the potential seems holistic, touching every part of the transaction lifecycle.
It really does.
That's a comprehensive breakdown of the benefits. But here's where it gets really interesting for me. How does all this theory about WCBDC, smart contracts, how does it actually play out when it comes to something as fundamental, as complex as governments issuing bonds? It sounds incredibly sophisticated in practice.
It is sophisticated, yeah.
Yeah.
But the real-world experiments are already showing us the tangible path forward. First, a quick overview of sovereign and supranational debt issuance methods. They primarily use either syndication or auctions. While these have distinct pre-trade differences, most experiments so far have smartly focused on next-generation automation for post-trade steps.
Why the focus there initially?
Because post-trade elements like documentation, settlement prep, distribution, they're common to both methods. They're highly operational, transparent, makes an ideal, kind of low-hanging fruit candidates for automation. Easier to tackle first. Numerous pioneering projects have explored this already. The World Bank was an early mover, issued its first blockchain bond on a private permission blockchain. Explicit goal, faster, more efficient, and more secure transactions, end quote. The European Investment Bank, EIB, has been particularly active, really innovative. In 2021, they issued a significant euro million bond on the public Ethereum blockchain, crucially, settled with wholesale digital euro from Banque de France. Their motivations were clear: reduction of intermediaries and fixed costs, better market transparency, as well as a much faster settlement speed. They also successfully issued another 100 million bond on a private permission blockchain, achieving impressive same-day settlement and cross-chain delivery versus payment, DVP. Other key experiments highlight broad central bank engagement. The Deutsche Bundesbank, for example, demonstrated feasibility, triggering conventional real-time gross settlement, RTGS, payments from a DLT environment, for more efficient securities settlement. And crucially, Banque de France, working with the French Debt Management Office, Agence France Trésor, and Euroclear. They experimented with on-chain settlement of French government bonds, using a permission blockchain. Their findings: highly encouraging. Easy transfer securities, CBDC tokens between blockchains, significantly reduced settlement time. And the solution removed more friction than traditional bridge solutions. Beyond individual central banks, the Bank for International Settlements, BIS, Innovation Hub, has spearheaded multiple impactful collaborative projects. Project Helvetia explored WCBDC for tokenized financial assets, integrating WCBDC into central and commercial bank core systems in Switzerland. Project Jura experimented with cross-border WCBDC settlement, specifically tokenized euro commercial paper, FX transactions, showing how central banks could allow access for regulated non-resident financial institutions. And Project Mariana investigated automated market makers for FX markets and settlement, aiming to significantly improve cross-border payments.
Finally, the Monetary Authority of Singapore, MAS, have been at the forefront since 2016 with Project Dubin, a comprehensive initiative covering decentralized cross-border payments, DVP settlement finality, interledger interoperability.
So what's the takeaway from all these global experiments? World Bank, EIB, Bundesbank, Singapore?
The takeaway is unambiguous. It's not just about feasibility. These diverse global experiments demonstrate a consistent pattern: significant reductions in settlement time, enhanced transparency, and a clear path to eliminating costly, friction-prone manual steps for post-trade activities. This isn't theoretical anymore. It's proven in action. And it's paving the way for the digital euro.
That's a truly impressive track record for post-trade automation, but this raises an important question. What about making the entire process automated? From start to finish, can we really automate the pre-trade steps too, like for an auction? That seems like a much bigger leap, given the complexities of bidding, allocation.
That's precisely the ambition laid out in the ESM paper, achieving end-to-end automation, particularly for auction-based debt issuance. by integrating these next-generation automation tools. An auction system, unlike syndication, which relies heavily on human relationships, discretionary decisions, and pre-trade. An auction can be designed to use conditional triggering, brought forward by smart contracts, for its entire lifecycle, including pre-trade. Let's walk through the proposed on-chain auction process. After the auction is announced off-chain, traditionally, everything moves onto the DLT, fully automated, transparent to authorized parties. Step 1. Token issuance. The issuer, or a designated technical third party, creates the debt instrument tokens, the digital bonds, essentially, and locks them into smart contracts within the issuer's wallet. These contracts are ingeniously programmed to automatically handle future corporate actions, coupon payments, final redemption, ensuring precise, timely execution without manual intervention. Step 2. Investor bidding and pre-funding. Investors interested. They place bids, also as smart contracts. Critically, these are pre-funded, meaning investors must commit their wholesale CBDC at the exact moment of bidding.
That's the game changer you mentioned. Reduces settlement risk massively.
Exactly. But investors retain flexibility. They can modify or even cancel bids up until a predefined deadline. And it's vital that bids are only visible to the bidder and the issuer, ensuring privacy, like a traditional sealed bid auction. Step 3. Automated allocation, or manual decision. Allocation then proceeds. This can be fully automated based on issuer-defined rules, like a maximum acceptable yield, or it can remain a manual decision point for the issuer. To align with their broader yield curve strategy, the beauty is its adaptability. Single price, multiple price auctions. It can handle different methods. Step 4. Conditional execution. For successful bids, the auction smart contract is triggered, automatically initiating the delivery versus payment DVP settlement. For unsuccessful bids, the smart contract immediately automatically releases the locked WCBDC back to the investor's wallet. No unnecessary tied-up funds. Step 5. Instant atomic settlement. This is where the DLT magic really shines. The DVP process for successful bids. It's a simultaneous atomic exchange. Wholesale CBDC tokens released from the investor's contract instantly transferred to the issuer's wallet, while the dead tokens, equivalent to the successful bid, are simultaneously released from the issuer's contract to the investor's wallet. These steps execute automatically, simultaneously. Instant atomic settlement. Both legs happen at the exact same moment, eliminating settlement risk entirely. The value proposition of this end-to-end system, immense, eliminates numerous manual steps between trade and settlement, condenses the process from days to mere seconds, drastically cuts costs, eliminates a multitude of risks.
Like streamlining a multi-day logistical nightmare into an instant, seamless exchange.
Precisely. We've even seen real-world parallels. Christie's moved to fully on-chain auctions for NFT sales on Ethereum, using bids as smart contracts locking up crypto. Now, while this blueprint is optimized for auctions due to their structured nature, the mechanism can be adapted for syndication-based issuance. Steps 1, 4, 5, and 6 remain largely similar. Post-trade steps are issuance method neutral. The key challenge in syndication is step 3, allocation. Full automation here is more challenging.
Because it relies so much on relationships, discretion.
Exactly. Syndication relies heavily on the issuer's investor relations strategy, discretionary allocation decisions by lead managers, based on market demand, investor profiles. However, if an issuer were to clearly define its allocation rules across predetermined investor categories, this too could be coded into smart contracts, bringing greater automation, efficiency, even to syndicated deals. It would mean a shift, though, from highly discretionary to rules-based allocation.
Okay, if we connect this to the bigger picture, considering all these benefits, challenges, what's the most promising technical setup to make a wholesale digital euro a reality, safely, efficiently, specifically for debt capital markets? Sounds like there are many architectural choices.
Based on the meticulous analysis in the ESM paper, a programmable on-chain wholesale CBDC is overwhelmingly identified as the optimal solution. The best way forward: the pre-funding of bid smart contracts, explicitly stated as a prerequisite for end-to-end automation, where the greatest efficiency gains lie. And critically, settling transactions with central bank money offers the highest standard for both issuers and investors, because it eliminates the credit risk for both parties, providing ultimate safety, finality. Other alternatives, while conceptually interesting, they just fall short of this ideal. A wholesale stablecoin, for instance, introduces counterparty performance risk against its issuer, the risk they can't honor the stablecoin's value. Tokenized commercial bank money, like JPM coin, creates both counterparty risk and a credit risk against the commercial bank issuing the token. Even bridge solutions linking DLT to conventional RTGS systems like Target 2, While maybe a readily implementable interim solution, they risk additional intermediaries, lack key functionalities like conditional time locking of funds, higher transitional infrastructure costs, or slow responses to innovations. Crucially, they might potentially not support pre-funding of smart contracts, which, as we discussed, is vital for end-to-end automation.
So the conclusion is pretty firm then.
It is. At this stage, an on-chain wholesale CBDC appears the best solution for reducing risks and reaping the most benefits of smart contracts. It's the highest integrity money meeting the most efficient technology. This leads us directly to the ideal architectural setup for such a WCBDC. Intermediaries acting as node operators within a private permission DLT. The core idea. Regulated financial institutions, the very entities underpinning our financial system, now could be authorized to run nodes on a private permission DLT. Within this robust model, there are distinct, crucial roles, ensuring both decentralization and control. A notary node run by a central bank provides uniqueness consensus, validates transactions, maintains a master record. It also authorizes new operating nodes, maintaining tight control. Operating nodes run by regulated actors, commercial banks, traditional CCPs, maybe large investment firms. They maintain part of the DLT, a running record of transactions. Active participants, gatekeepers, also regulated actors. They grant market participants access to the DLT and its dApps, performing essential KYC checks as a prerequisite, the crucial entry point. And finally, users.
The market participants themselves, issuers, investors, other banks, whitelisted by at least one gatekeeper, allowing them to interact directly on-chain. This specific setup offers numerous compelling advantages. Significant efficiency. Market participants need KYC approval only once by one node operator for the whole network. Privacy can be rigorously enforced. Limiting node operators' view to just public addresses ensures competitive confidentiality. Security is greatly enhanced. Easier to protect a private network against cyber attacks than a public one. It provides crucial flexibility. An exception management system could define processes to override immutability in special cases, like correcting errors. Programmability is ensured by careful choice of underlying tech, allowing node operators to deploy new smart contract applications as needed. And the central bank's crucial role, issuing WCBDC, operating the notary node, provides unparalleled trust, oversight, systemic stability. Now, the governance of such a system needs detailed study, preventing nodes from censoring transactions, eliminating front-running risk, establishing common standards.
But this model addresses many of the current hurdles we discussed. Looking at the implications for primary and secondary markets, it's important to understand the evolving roles. Market participants still need whitelisting by a gatekeeper. For AML-CFT compliance, that doesn't go away. In the primary market, despite potential direct wallet access, the paper emphasizes the role of intermediaries will remain unchallenged.
Why is that? If the tech allows direct access.
Because banks provide invaluable advisory services. On deal size, maturity, pricing, they play a key role in long-term investor relations. They generate market interest, demand. This system may require intermediaries to adjust their business models, but would not disrupt them. Their expertise goes way beyond just technical operation. It's relationships, market insight, strategy. However, the secondary market could see more significant long-term transformation. Market participants with direct wallet access could directly transfer security in exchange for wholesale CBDC instantaneously. This could lead to marketplaces that help market participants find trade counterparties, potentially transforming current over-the-counter markets, which are bilateral, often opaque. These changes, while profound, would only materialize over the longer term. So the market-making role of banks will remain strong for the time being.
So it's a gradual evolution, not an overnight revolution, but the potential is there to reshape how securities are traded.
Definitely. The potential is significant, even if gradual.
So what does this all mean for us? We've really taken a deep dive here into how a wholesale digital euro, far from the speculative crypto world, could fundamentally reshape our capital markets, from its digital origins to its practical, sophisticated applications in something as fundamental as sovereign debt issuance.
To summarize, the core finding from the European Stability Mechanism paper is unequivocally clear. Next-generation automation tools, DLT, smart contracts, oracles, hold immense potential to increase the efficiency of debt issuance and trading. This translates into a multitude of tangible benefits: significantly faster execution via programmability, enhanced transparency while respecting privacy, a powerful contribution to financial stability. We've also highlighted how this new approach would effectively reduce existing risks in legacy systems. Settlement risk, human error. While it introduces some novel DLT risks, the paper concludes these could be mitigated by applying the right design choices, especially around AML-CFT regulations and cybersecurity. All these factors combined should lead to tangible cost savings across the entire debt capital market value chain, creating a leaner, safer system. The paper strongly suggests that on-chain wholesale CBDC with programmability features do seem to be the missing piece that could further the emergence and use of tokenized capital markets at scale in this market segment.
The critical ingredient to unlock mass adoption.
Seems like it. And the recommended architecture. For achieving this safely, controlled, unequivocally a private permission blockchain with nodes operated by regulated entities, with the central bank operating a notary node. This design leverages DLT's strengths while meticulously embedding necessary regulatory oversight, trust, and resilience, paramount for such vital financial infrastructure.
This raises an important final question for me then. After all this groundbreaking work, all this experimentation analysis, what's next? For this incredibly complex, exciting area, what are the remaining hurdles? Avenues for further exploration before a wholesale digital euro truly becomes widespread.
Indeed, there's still a significant road ahead. And the paper is candid about remaining challenges, future research areas. Firstly, a pressing need for a detailed technical analysis to ensure the absolute best choice of technology to meet these high-level requirements. Secondly, competition and antitrust regulation need deeper investigation, need to determine if competitors would be ready to operate nodes in a common distributed infrastructure, a practical strategic consideration, collaboration among market players. Thirdly, comprehensive governance rules must be meticulously elaborated, establishing decision and financing arrangements needed for progressing towards a permissioned private network. How will decisions be made, funded collectively? And crucially, the implications for central banks and regulators require in-depth consideration, especially governance considerations and the need to control central bank money on distributed ledger technology. These are fundamental factors that any central bank would wish to consider in depth before issuance of a wholesale CBDC on distributed ledger technology.
Finally, continued experiments around on-chain end-to-end debt issuance automation are vital. These will help confirm anticipated gains, explore further bridge solutions as a potential intermediary setup for gradual transition, and crucially share experiences across the community, build collective knowledge. The overarching goal remains clear: employing digitalization as a means to enhance capital market efficiency.
So it's an ongoing journey, innovation, collaboration. But the path is much clearer now.
Much clearer, yes.
Sure. Final thought then. Considering how deeply intertwined our financial systems are, how quickly technology is advancing, what do you think would be the most surprising, unintended consequence, positive or negative, of a fully functional wholesale digital euro in action across Europe? Maybe something the ESM paper didn't even touch upon. Something for our listeners to ponder.